Good morning and welcome back to Almus Market Mornings, your daily dose of global financial updates. The March madness continues, starting with the higher US inflation. But what's really interesting is that equities in the US have hit all-time highs, still sticking to the belief that Fed will be able to cut rates this year despite hotter than expected inflation. Indian headline CPI was broadly as expected, coming in at 5.09% year on year. Good morning, JK. Hotter inflation for US. How do you read this number in the context of a Fed pivot?
Yeah, good morning, Swaraj. Yesterday was like a double header in the evening session of an IPL season, and one of them was a really inconsequential match. The other one provided more excitement, of course. The Indian number coming at 5.09 versus 5.10 last month hardly mattered, because even if it had come at 4.90, it has had no policy implication, because we have very strong growth, and the inflation is more than 1% above the target that RBI set for itself at 4%. So it wasn't really mattering for the markets. And yes, I don't think that impacts the rupee as well, or even the bond market to that extent. Industrial production came at 3.8%, slightly lower. Manufacturing sector was exhibiting a slight slowdown, but overall, out of the 23 sectors, 8 of the sectors recorded slower growth, but others were doing okay. So, as I said, inconsequential data as far as Indian macro is concerned. But in the US economy, the consumer prices showed another solid increase in February amid higher costs for gasoline and shelter, and suggested stickiness in the inflation that we have been talking about, and that keeps the Fed's rate cut discussion alive. So the consumer price indexes rose 0.4% after 0.3% in January. Year on year was again higher at 3.2% versus 3.1% in January. Now, the gasoline prices was 3.8% higher versus 3.3% in January. Shelter was, of course, slightly lower, because these two categories contribute more than 60% of the monthly increase in CPI. Now, though the numbers add to uncertainty about the rate cuts by the Fed, but some analysts actually pointed to seasonal factors and said difficulties adjusting the data for price increases at the start of the year, and that had infused a bit of noise into the CPI report. Perhaps this was the reason why we had markets not reacting much to it. As I said, the policy implication, it still keeps in the market suspense as far as the rate cut timing and extent is are concerned. Market discounting actually does not show much change from the probabilities of an outcome, that is of a cut in June, compared to what it was before the data. Of course, we do turn our attention to the PPI number on Thursday, and then on to the FOMC meeting next Wednesday, more particularly to the dot plot of the individual Fed members. Now, important point to note, as someone pointed out, which I like to read, is since policymakers are willing to be patient in order to gain confidence inflation is coming down, they may just be as patient to see if inflation is heading up again as well. So, I mean, they are advocating more patience in such a way that you cut in a hurry and then you don't have to reverse as it has happened in the past. Now, as I said, the market impact immediate was very tepid and somewhat, in fact, surprising. Dollar did not move more than 10 basis points up to some point of the data, after the data. But bonds reacted a bit late, and that too was more in reaction to very poor response to new issuance of 10-year paper, where the yield was higher than the final yield was higher than what was market expecting. So it was a 39 billion fresh issuance that yielded 4.166% versus 4.093 in the previous auction. There's also some concern about 22 billion of 30-year bond that is likely to be issued today. Other than that, yes, we did not have much reaction in the bond market and to the CPI number. Stock markets, again, most players concluding that Fed is going to cut, rates are peaked. Fed, the Powell himself has stated in his recent testimony that the rates are peaked, and Fed will be ready to cut when they get more confidence, and market feels that the confidence on the inflation coming down will increase as we go along. So we had a good rise in US stock market. Of course, once again, a lot of upside was contributed by the new age chip stocks, and some of them rose very strongly, and that aided the sentiment, taking up the S&P 500 as well as the Nasdaq more than 1%. So the currencies are concerned, euro, which is a bellwether of the USD index, made a minor dip, but held above 1.09. And what is telling is that USD yen, which had a temporary blip, is back where it was trading before the data. Pound, of course, had a minor sell-off yesterday after weaker than expected wage inflation. So all in all, you can see that the currencies are not really reacting to the higher than expected CPI data, which normally would have been a surprise. But as we have been sharing in our various updates, there is a certain bias towards a weaker dollar, irrespective of these cyclical numbers. Therefore, we are not really surprised that dollar is actually holding down despite the higher number. So we really have to see if there is a weaker number, how the dollar would react, whether it would fall more. We have a chance to see that on Thursday when we have PPI number and the retail sales number to assess. Now, on the rupee, yes, again, not much to add. It was a very tight-ranged market yesterday, but again, held well above 82.73. Post CPI number, there is, seen to be some bidding up in the USD-INR, but that's more down to some expectation of an outflow, of US dollars from equity market, but a specific block deal that market is talking about. But that really we have to see, because as we go near 80 plus and 80 to 85, sorry, 70 to 85, we will see, exporters coming in and selling, particularly considering that it is a month of March. So, but just finally, something that we should not lose sight of amid all the noise of the cyclical numbers, the macro numbers in the US fiscal deficit for 2024 is projected at 1.6 trillion USD, and that is coming to 6.8% of GDP. So these, I am hinting at these numbers quite frequently because this is the structural number that actually is keeping the US dollar on the defensive, because that's a very concerning macro factor that the larger players are looking at. So we'll see how it plays out, but it will take some time for it to be played out. Thank you.
Thank you, JK. And as you said, markets did not react much to the CPI number, but it seems that the rate cut timing and extent still seems to be in a suspense. So more patience is being advocated, both to see if inflation is coming down, but also remaining patient if it inches higher. We had a good rally in stock market in the US, with a lot of rally being contributed by the chip stocks. Currencies did not react much initially. Of course, there was a knee-jerk reaction, but post that it settled in the old familiar ranges. But after the US CPI, there definitely seems to be a bias toward a weak dollar. For rupee, we remained ranged, but USD are well held above 82.70. So that was for the rupee. That's it from us today. Thanks for listening. Tune in tomorrow for the latest in the financial market.